If you've been watching the headlines like last week or so, and following the Netflix story, you would have seen a notification that sent ripples through the media world. Netflix is officially or has officially walked away from the Warner Brothers bidding war. Now, on the surface, this could look like a loss, although the stock said otherwise, but they are losing a lot of good IP walking away from this, and a legacy library that any streamer would kind of want. But if you look at the commentary coming out at the Morgan Stanley TMT conference, and this is where all of my information is taken from, specifically from the CFO of Netflix, this wasn't a loss. It was a choice. And in my opinion, it was a smart one. Today, I'm going to break down the why as to why they walked away and cover a few other metrics that the CFO did touch on. We're going to talk about the $2.8 billion that is now sitting in Netflix's pocket, and also why they're telling investors they're tracking the wrong metrics. Netflix is quietly morphing into something much bigger than a TV company, and it's really starting to show. Let's start with the deal itself. The CFO was incredibly blunt, and this is a quote from him, and he said, "It's nice to have at the right price, not a must-have at any price." And that quote made me so happy as a shareholder, because the number one job of management is capital allocation, and you don't want to overpay for anything. That quote proves that they are no longer a content desperate company. In 2018, Netflix was burning through cash to build a library from scratch, but today they have a better framework. They walked into the Warner Brothers with a negotiation ceiling, which was smart, and the moment the price crossed that line, they didn't feel like they had to bid it up. They just walked away and let Paramount have it. And the best part is for shareholders that $2.8 billion stays with the company, and they can earmark it for something different. It was immediately pretty much reallocated to their share repurchase programs, and I love buybacks. Essentially, Netflix looked at Warner Brothers and said, yeah, we'd rather bet on our own company than on yours. And that is a level of arrogance that you can have when you have such a large organic runway. CFO also pointed out that even though Netflix feels big with 325 million subscribers, they're actually still pretty tiny in the grand scheme of things. They have less than 10% of the total TV view share and only 7% of the addressable revenue in the countries where they operate. And Netflix feels that they can grow more just by being Netflix, and then bringing on another company and having to go through a transition and a merger and all of that, especially for that much money. They didn't want to risk that. The CFO also went on to talk about an engagement trap, a metric that people tend to look at in shareholders that's making them a little nervous. Investors have been worried because the view per hours per household at Netflix is slightly declining. And on paper, that does sound like people are getting bored and not watching as much Netflix, but the CFO did address this at the conference. He basically told us that we were tracking the wrong number. He calls this a compositional shift, not a structural one. Think about it like this. Netflix growth is coming from international markets like Japan. And a Japanese household, on average, watches about half or 2/3 of what the US households consume on TV. So as Netflix grows globally, the average hours per household has to go down because it's just simple math. It's not bad that this is happening. But Netflix as a business is getting healthier because their internal quality per hour metric has hit a record high in Q4. And they are focusing on impact and ads rather than just keeping the TV on and having it run in the background as noise. They are moving away from total view hours as their number one metric, or kind of as, I guess you could call it, their North Star. And they're looking for holistic engagement. Now, because we're talking about ads, I kind of want to go into some numbers here because as a shareholder, again, I really love this. This ad idea is no longer a test or a beta program. It's a $3 billion engine for Netflix. For the first time, Netflix is running its own ad tech. CFO expects revenue to double from $1.5 billion last year to $3 billion in 2026. And to put that in perspective, that's 25% of their total incremental revenue growth. They aren't just selling subs anymore. They are selling eyeballs at premium CPMs. They aren't chasing volume or trying to fill every single slot. They're managing for total revenue, and then there's the content itself. So there's ads, which is like a major behemoth of revenue, and there's the content, and there's the sub. Look at what's happening with formats. Scripted shows are foundational, but look at the edges. Miss Rachel, a YouTube native creator, was the 9th most watched show on Netflix in the second half of 2025. Netflix is coming from every viewing point. They are expanding into a lot of different things. They are expanding into video podcasts, which are over-indexing on mobile for morning and afternoon commutes. Then there's also vertical video. They're testing clips in the mobile feed right now. And of course, we have live sports and events, which is huge. right? That's a huge watching total addressable market. They have a full mobile UI overhaul coming in the second half of 2026. And they aren't just competing for your Saturday night movie anymore. They are competing for your Tuesday morning commute. They are competing for your Saturday morning coffee time. They are competing for everything. Now I'm just going to address boring investor stuff, but it kind of actually matters if you're invested in this company or thinking of investing in this company or want to sell out of this company. Margins. Some investors got spooked by the 20 billion content spend for 2026. It sounds like a lot, but the CFO pointed out that their operating margin is projected at 31.5% for 2026. When he started in 2019, it was only 10%. They've grown margins by roughly 2 percentage points every year for the past 5 years, and that is incredible discipline. They are spending more on content, yes, but that spend is growing slower than their revenue, and that's important. Spending more on content, but that is growing slower than their revenue. Here's my conclusion. Netflix walked away from Warner Brothers, and I don't see it as a company in retreat. I see it as a company that is so confident in its own engine, in its international growth, and in its margin discipline that it does not need a blockbuster merger to win. It doesn't need Warner Brothers for that price. Netflix is not a streaming service only anymore. It's a global ad-supported multi-format media machine that's finally figured out how to make a lot of money while doing it. That wraps up this episode for Netflix. I'm half of Compound Everything. Like and subscribe this video because it really helps our channel, and I will see you next time.